Welcome. This is Bert Dohmen, December 13th. We're going to talk about the junk bond crisis right now. This is looking very precarious. This reminds us very much of 2007, 2008, when the first warning flags started flying. We received the first warning about 10 days ago when the yield on triple C junk bonds, this is the lowest grade, soared to 16.6%. Here's the chart, courtesy of Alhambra Investment Partners, and this is a new record high. This was a real warning. In fact, the breakout over the December 16th, 2014 high was the first sign that something really was going on beneath the surface that was not being advertised in the financial media. Now let us look at the ETF for high yield corporate bonds, which is the HYG. And here you have a chart that goes back to again, the middle of 2014, and you can see here it was still doing okay, and then suddenly here in the last quarter of last year, we started seeing some problems coming up, and this was probably due to the precarious situation of energy companies, which had raised a lot of money in the junk bond market. And here the bear market started in full swing as we went into the second and third quarter of this year. And you can see here is last Friday as it plunged through this regression channel and to new lows. This was caused by a notable junk bond fund from Third Avenue actually shutting down. It shut down rather than let investors liquidate their shares because they couldn't sell the bonds that they had in their portfolio. There was no market, and therefore they had to shut the fund without SEC permission. And now the investors are going to have to wait. One analyst said they might have to wait 12 months or longer in order to get all of their money out of the fund. So this is now a serious situation, which is, of course, being downplayed in the media. It's not getting a lot of attention because they don't want to pour gasoline on a fire. But this is very serious. This is very much like Bear Stearns in 2007, in the summer of 2007, when two of its hedge funds failed, and that really got things going in the credit markets. What's really important here is the volume of this ETF. Look at the volume spiking. This is the highest volume we have seen on this ever, on this ETF, and it shows you that the big money that had been striving for high yields is leaving. And here's the chart of the Third Avenue Focused Credit Fund, the junk bond fund that was just shuttered, leaving investors out in the cold. Here you can see a big decline from over $10 a share to $6.50 a share at the low last Friday. This is very important. The line over here, this is the 50-day moving average. When it crossed the 50-day moving average here, that was a very good sell signal. So you always want to use technical tools like this to find out what's really going on in the markets. Now, we also got another piece of news late on Friday, and that is that a hedge fund that invests in junk bonds and distressed securities, Dohmen Capital, was actually gated, which is what it's called, when investors get a message that they are not able to liquidate their shares and get money for their shares. So here you have a hedge fund now closing as well, just as the Bear Stearns funds did in the summer of 2014. So we're getting now to the point where the credit markets are going to see a rush for the exits out of the anything but the strongest credit. And the strongest credit, of course, is that of the U.S. government, and U.S. treasuries will get much of the money that is fleeing out of the other areas. And therefore, you will see the U.S. Treasury bonds doing very nicely, in our opinion, as it is the safest and probably only place for safety. Many people don't consider money market, the ordinary money market funds safe, nor the banks. And we have been advising since early this summer to shift out of normal money market funds into U.S. Treasury only money market funds. And this is different than government only. It's U.S. Treasury only. You don't want to get into the government only money market funds because they have paper from the GSEs, which is Fannie Mae and Freddie Mac, which we don't consider very safe. Okay, this is Bert Dohmen signing off for now. If you want to stay tuned with how this credit market will develop, as we did very well for our subscribers in 2007 and 2008, when they made a lot of money during the panic of 2008. We will do so again, and it's certainly well worth the subscription price. Go to domencapital.com. Thank you very much for being with us.